Boa tarde a todos. Estamos de volta com Jay Peloski, depois de férias curtas que ele teve, de uma semana e pouco, e hoje, excepcionalmente, na quarta-feira, por causa do feriado do Dia do Trabalho, e, enfim, nada, como um dia de hoje, para a gente perceber, entender como que é importante a diversificação internacional, e ainda mais, com os insights vindo de alguém como o Jay, que é uma autoridade em mercados globais. Então, deixa eu passar para ele. So, Jay, thanks very much, and it was great to have you after the short and well-deserved break that you had, especially with some great content and lots to talk about. So, without further ado, people are used to our lives, so I'll turn to you. So, we can go the usual script. So, thanks again, and it's great to have you.
Thanks, Roberto, and great to be back. Vacation was wonderful, but I did come back with a lot of thoughts and wrote them up in my monthly, which went up on the Ohm Research site on Friday. But I know people were on holiday, both Labor Day in the U.S. and in Brazil. So if folks haven't had a chance to read it, we're going to talk about it here. Yeah. And the title of the monthly was "Focus Forward," because we all know, if we're in the business, in the investment business, that when people come back from vacation, summer vacation, at least here in the US and Europe, they tend to start to focus on the out year, right? Analysts hone their earnings estimates, strategists their market outlook, and economists their growth, etc. So the calendar says it's time to focus forward. Markets are forward-looking discounting mechanisms, so they drive us to focus forward. And then, of course, COVID speed, which we've talked about now for really the last year and a half or so, also demands that we focus forward. And so that really was the thrust of the piece. And before I get into the forward-looking things, I also talked about what comes, what goes, and what stays. And so in terms of thinking about what stays, I believe we're going to have continued above-trend global growth through the rest of this year, through 2022. We're going to have above trend inflation, but not elevated such that it's going to pose a major concern. But inflation will be above trend as well, I think, globally. We're also importantly going to have, I think, just stellar earnings power, again, globally, as we have seen coming out of the very short COVID-inspired recession. And then I think we're also going to have, importantly, and I write quite a bit about climate in this monthly, we're going to have continued in-your-face kind of climate change. And I think that has big ramifications, which we'll speak of. Yeah. What goes, I think, is going to be the 24/7 focus on COVID, right? I believe we're at the tail end of the kind of COVID Delta focus. Cases are rolling over in the US and globally. We're going to have continued vaccination efforts, vaccine mandates, booster shots. And importantly, and I've spent some time on this, there doesn't appear to be any other variant with anywhere near the impact of Delta anywhere on the horizon. And in fact, Delta has been so powerful that there's a sense that it has kind of squeezed out the opportunity for other variants to manifest. And so given how focused the world has been on Delta, I think it's important for us to start to think about a world where COVID is kind of in the background as opposed to, right in our face. The other thing that I think is going to go is QE. And I expect over the next quarter or two, we're going to see the Fed begin to taper. Probably in the middle of next year, the ECB start to talk about tapering. But importantly, we also have on the other side, the PBOC in China standing ready to provide liquidity should the world need it. And then finally, what comes, I think, is big government. Because much as COVID has demonstrated, climate change demonstrates that these issues are too big for any one company to deal with, or even one country to deal with. And so I think investors need to start to understand that big government is going to be a factor. It's going to be a factor for the next foreseeable future, the next number of years, and we should welcome that as investors. And then the last thing I think that comes is going to be higher interest rates. I expect to see rates rise in the U.S. and globally, particularly in the developed economies, as we go through the end of this year and into the early stages of next year. So that's kind of the focus forward. What comes, what goes, what stays. And now I'll stop there and see if that generates any questions on your end, and then we can go into the whole climate in the typical order of the global risk nexus as we normally do.
Yeah, and with respect to COVID, as you started and you mentioned first, so I mean, I remember we discussed and also you pointing out that there was excessive concern with the Delta variant because if people have been properly vaccinated, the likelihood of something bad happening is very low. How do you see? I mean, the issue of supply versus demand for vaccines in the second half, including you still have the reluctance of some groups in the U.S. to vaccinating, and also the fact that in Italy they will most likely make it compulsory, and most countries are saying, and even Dr. Fauci talked about the most likely probably the right vaccine regime is probably 3 doses. So how do you see that playing out and affecting the economy and markets?
Well, first of all, I think, and I've written about this for some time, I believe the markets have fully discounted the Delta variant. And they did that way back now, almost 6 weeks ago in middle July, in fact, the 19th of July. And that's when you had, that was a Monday, you had a week Friday, you had a week Monday. And the tell for me was looking at our model portfolios. As you recall, we have 2 models, one our flagship global multi-asset, and then the second one our 100% thematic TPW20 model. And what struck me was how almost, I'd say 90% of the positions, and between the 2 portfolios, we probably have 30 to 35 separate ETF positions. And between the 2 portfolios, 90% or so of those positions all bottomed on that same day, the 19th of July. And they really, for the most part, haven't broken below those levels. And that's why I say the breadth of that kind of sell-off, it speaks to me of deleveraging and position cleansing. And that's why I say, in my view, markets have already discounted Delta. There's still obviously a huge amount of discussion about it. Newspapers are filled with it, TV, radio, social media, etc. But from a market perspective, I believe we have already fully discounted Delta. And when I look, as I did, because we're going through our portfolio review, I'll just tell you, I can tell you exactly. ACWI is up 7% from that low of the 19th. The S&P is up 6. NASDAQ's up 7. EFA is up 7. EM is up 1. So broad EM, EEM, that's the ETF. So that to me suggests that Delta has been pretty fully discounted. And now you look at Europe having vaccinated 70+% of their adults. The U.S. finally getting 75% of adults with at least 1 shot. Japan rapidly closing the gap, providing over 1.5 million shots a day to its population. China having successfully closed off the latest little outbreak with quite a draconian lockdown, as we all know. But the reality of that is that that's the bulk of the global economy. And the bulk of the global economy is I believe, kind of already dealt with the vaccine and with Delta. And going forward, to me, what's really interesting, and we can talk more about this in the economy section. What's really interesting to me is that Asia, which has been under kind of a pretty strict lockdown, is finally starting to reopen. And I don't mean just China. I mean, more broadly speaking, Asia writ large. And so that is something that I think is going to have a big impact on the global economy and on global financial assets. And it's something that virtually no one is talking about.
Mm-hmm. No, it's a great call, and I mean, there's also we can talk about later about what's going on with steel production in China, and compounded with the fact that China may want to see higher growth rates next year anyway, because it's the Politburo will probably reappoint Xi Jinping. It's about time. I mean, in short time, people will start anticipating the acceleration of growth into China. But I mean, now let's turn to climate. I mean, it is one of our. I mean, it's probably my favorite topic, and it's yours as well. And I saw one of your. You shared an article. I think it was last week, saying that 1 in 3 Americans have been through a climate emergency this summer. I mean, that's a lot. I mean, it's was either a hurricane, the floods, or the the floods in New York, or the fires.
Right.
So, I mean, how much more do we need, for this to get a bigger focus, and how is that playing out, in your recommendations? Talk about carbon, yeah.
Yeah, no, I think climate is getting a huge amount of attention, Roberto, and I know it is in Brazil as well, right? With there's voluntary water restrictions now being implemented in Brazil, given the dependency on hydropower. But yes, the climate is in your face, right? It's in your face, climate change, and it just reminds me that there's absolutely no doubt in my mind that the single biggest global macro issue of this decade is climate. Now, I've said this before, but it bears repeating. And so I think that's where I start as an investor. As a macro investor, I start with the view that climate is the single biggest macro issue of the decade. And as I thought about it and talked about it with people, it's kind of like there are 2 big things going on. One is climate and one is crypto. And it's funny that they both begin with the C. And you kind of have to pick one or the other to focus on. The way I focus is going to be on climate. But as I said the other day, I keep a size 14. That's a shoe size, size 14 foot in the crypto camp as well through our TBW20 thematic portfolio, where we have exposure, some significant exposure to the crypto space. But climate is really where I think the focus is. And what's interesting and exciting to me is that in this monthly, I introduced the concept of climate speed. Now, I know you'll recall COVID speed, which was a big deal for me last year.
It was totally right. I mean,
yeah, exactly.
It had, 5 years to develop a vaccine, and they have it in 1.
Exactly. And that COVID speed, I think, has completely changed kind of how the world is operating. We're operating at a faster pace in large part because of COVID speed. And now I'm introducing kind of alongside that the concept of climate speed. And what climate speed is the telescoping of time, the shrinking of time between the short run and the long run. And just think about it for a minute. We've all heard about climate change. We've all read about it, talked about it, but it's always been this thing off in the distance. And this year, as you pointed out, it's in everybody's face. And it doesn't matter whether you're in the US or in Europe or in Asia or in South America, it's in your face. And so this is driving people to recognize that climate is something we have to deal with right now. And the other factor, of course, is that the Paris Accords and the targets of reaching peak carbon by 2030 give us a timeline. And when you look at what needs to be done to meet the target of the Paris Accords, in the US at least, you realize that the Biden infrastructure plan, the big $3.5 trillion human capital plan, also has a very big slug of climate-related activity and money tied into it. And so for the US, if we do not pass the Biden plan or some version of it, that has the climate and the clean electricity programs in particular involved in whatever passes, then we can pretty much forget about meeting the Paris Accord targets. And so that's a perfect example of what I mean by telescoping time. We're talking about targets that are 9 years out, but if we don't pass this legislation in the next 2 to 3 months, we're probably not going to come close to those targets. And that's telescoping time from 9 years to 3 months. And I think that's absolutely critical for investors to think about. And the other point I introduced in the climate section of this monthly is the idea of proper pricing for common goods, like clean air and clean water.
Yeah, it's the idea of externalities, right?
We've talked a lot about clean air and carbon on these lives, and carbon continues to be one of our favorite positions, one of our biggest positions in the climate space. But I also want to talk about water, because it's very clear. I mentioned Brazil already, voluntary restrictions on water usage. Same thing happening in the West, the American West, which is in the grips of a 20-year drought that has not been this severe certainly in the last 100 to 200 years. And it's leading to the first significant reductions of water usage in the American West starting next year. So I believe that much as carbon is going to be repriced and is in process of being repriced, water is going to be repriced as we go forward. In the use of water, how much you pay for it, what it's used for, these common goods are going to be repriced as we go forward. And again, that's an opportunity for investors. There are ways, and we are exposed through ETFs on water to participate in this as these common goods get repriced. So climate continues to be the single biggest segment of our TPW 20 100% thematic portfolio. It's almost a third of that portfolio at this point. And I believe investors absolutely have to think about climate, understand climate, and invest in climate. This is where every government in the world is going to be spending a lot of time, money, and effort for the next decade. And we have that timeline to get to 2030. And so whether it's carbon or lithium or electric vehicles or solar or water, the opportunity to be involved here is significant. And certainly at TPW Advisory, we are very focused on it.
You know, that's right, and it's something that I like to say, and I think I repeated that quote before here. Is this is the first generation which is witnessing the effect of climate change, and the last one that can do anything about it. So you're right, and so you talked about carbon, which is doing great. I mean the carbon ETF, and I want to ask you about two questions. One is water. Is there any way where you could play the water theme, and is it you've been right also on ICLN. It was as high as 34. It's now back at 22, 23. Is it the time to be back in?
Well, on water, we are invested via PIO, which is the International Water ETF. It's a very sizable position in our TPW thematic, as well as a position in our global multi-asset. For the most part, where we can, we obviously double. If we like an ETF, we typically have it in both portfolios, and it's just a question of sizing. The TPW 20, obviously only 20 ETFs size, the positions are chunkier. The global multi-asset, because it's global and multi-asset, had more positions, sizes are a little bit smaller. So PIO is the way we're playing the water theme. ICLN, to be honest, Roberto, I haven't looked at it in a while. We traded out of that and replaced it with LIT, which is the lithium play. Some months ago, we continue to really like lithium. But the other one that we should probably talk about a little bit on this, in this theme is uranium, which has been a very strong mover the last month or so, I think up 40% or so. And that's certainly an area where investors, again, need to take a look at the idea of nuclear power and kind of the changing dynamics that are taking place within the uranium market that is leading to this kind of performance. Now, right now, obviously, with a 40% move in a month, it's probably not the time to jump right in. Probably it's overbought. If you look at the relative strength index and the ETFs that we look at, they're overbought. So probably just watch it for a little bit here. But certainly, again, the idea of nuclear power, of clean energy, of the need to be able to provide clean power and energy going forward is something that every country in the world is going to need to deal with. And so, as we've talked about, this is a big theme of ours. We play it through many different ETFs, and it's an example of where I think we have a bit of an edge at TPW Advisory versus a lot of other folks who are not as fully focused on thematics as we are. As far as I know, for example, the TPW 20 100% thematic model portfolio is one of the very few model portfolios out there that is completely dedicated to thematic investing.
No, that's fantastic, and we fully agree. So, I mean, can we move now to economy? So, I think the concept is, you brought this concept before, you talked about it, which is the fact that people struggle with the idea of peak growth, what does that mean for the U.S.? How you compare the different stages? How let's say the three major blocks, let's say U.S., Asia, and Europe, are in the economic cycle. And then we can kind of take it from there.
Yeah, no, I think that's exactly right. Because one of the things that I've been looking and pointing towards is this idea of a synchronized global expansion, right? Where all parts of the world, remember our tripolar world, as you pointed out, Asia, Europe, and the Americas are the three poles, thus tripolar world. And I've been looking for this synchronized, meaning all three regions going together, synchronized global expansion. And we really haven't had it. When Asia was humming in the spring, the US was just starting to get going, but Europe was lagging. Now, Europe and the US are in pretty good shape, rolling off of peak growth. But as you point out, importantly, peak growth does not mean late cycle low growth. It means we're normalizing to what I think can be potentially above trend growth going forward, which we can get into hopefully in the policy section of our discussion. But here, what I think is important is that the US has moved past peak growth, right? Peak growth was in Q2. We're having a little bit of a lull driven by Delta and the fact that the vaccination process in the US has not gone as well as one would have liked. Europe is in very good shape, probably the strongest of the three regions at the moment. And I think will continue to be in very good shape going forward, having vaccinated 75% or so of its population and having worked clearly able to continue to produce via the environment, notwithstanding some of the lockdowns. But what's most interesting right now and is getting very little attention is the potential for Asia to reopen. Asia, Goldman Sachs does a lockdown index, and they have pointed out over the last couple of weeks that Asia, broadly speaking, has been as locked down now as it was in the spring of 2020, namely March and April of 2020. And we've seen this reflected in the PMIs, not only in China's PMIs, but broad Asia and ASEAN PMIs being in the mid 40s. So I think what's really interesting is that quietly and without a lot of fanfare, Asia is reopening. If you look at China, for example, the airline departures, Barclays does a good job of showing airline departures across the different regions. China airline departures are up 30% versus where they were a month ago. Because when China gets COVID, any cases at all, they slam everything shut. They're trying to go to not have any COVID. And so they're very draconian. And now that outbreak has been squashed, they're starting to reopen. The rest of Asia is vaccinating aggressively and starting to reopen as well. And so I think the interesting outcome of this is that just when everybody gets worried about a slowdown, we're going to see PMIs picking up in Asia. We're going to see production picking up in Asia. We're going to see demand picking up in Asia. We're going to see easing of supply chain concerns, which everyone's worried about, and everyone worried is going to mean more inflation. I think the surprise is going to be over the next 4 to 6 weeks, the opposite is going to be what people are going to be talking about. We get the synchronized global expansion with the US, Europe, and Asia all kind of moving together. We're post-Delta, and we have an environment where the demand for commodities picks back up, oil moves, iron ore, copper, etc. These things really start to move, and you're back in that synchronized global expansion, which I think for the most part people have kind of given up on. And I think that is going to prove to be a mistake.
Mm-hmm. No, so that's very interesting, because what you're saying is that all of the because the issue of the bottlenecks and the supply chain disruptions, it's been kind of a moving target, right? It was kind of a summer issue, and now it's been pushed back. And what you're saying, the reason for this, I mean, am I right? So the reason for this is mostly COVID in Asia, and the fact that especially China has a zero tolerance policy towards COVID, and we know that's the case. I mean, we were just chatting, on the story on the ships, going to the Shanghai port, and what they do. So this is mostly a consequence of China having a zero tolerance policy on COVID, and that's going to phase out in the next, let's say, 5 to 6 weeks.
Well, I think it's already, as I mentioned, the airline departures are up 30% over the last month in China specifically. So that's China is already opening back up. And the other parts of Asia, I think we don't want to dismiss them or discount them. The rest of Asia, your Vietnam, Malaysia, Thailand, etc., also reopening. And I think that's going to be the big story, because we have to remember that Asia writ large is the driver to the global economy. It's the single biggest part of the global economy when you add China and ASEAN and India together. Bigger than the United States, bigger than Europe. And so that as that engine starts to kick over again, it's going to have big implications across the commodity space, across the supply chain space. And will be visible, I believe, in emerging market asset performance. I pointed out that EM has been since the 19th of July. We just did the numbers, right? EFA up 7%, EM up 1%. So EM has been a big laggard here, in part because of China and the policy mix that it's unveiled over the last couple of months, in part because of the slowdown. But as we move forward, those things slip away, and we're could be in a very different situation. And as I said, for me, what's interesting is nobody's talking about it. Virtually no one is talking about this. Everyone's talking about a U.S. growth, slashing Q3, strategists downgrading the U.S. market. That's the story right now. My point is that we should be focusing on the next story. Yeah. And the next story is an Asian reopening with big implications across the risk asset space, particularly in the commodity space and the markets that are associated with commodities.
Mm-hmm. Yeah, no, that's fantastic. And can we touch briefly on Europe? I mean, that's been one of our your and also my favorite regions. Mm-hmm. And it seems to be the bright spot in terms of global growth. You saw GDP was revised. I mean, the first reading was 2%, was actually 2.2% in the first quarter. I mean, if you look at some countries like Denmark, I mean, of course, it's it's a small country, but it's the first one that we see, the first glimpse of what life is. They're basically back to normal life. No masks, nothing. Over 75% of people have been vaccinated. So, I mean, is how I mean, my question is, why hasn't that superior performance has not been reflected in markets? I mean, why hasn't? I mean, is it still an issue of value versus growth? I mean, why hasn't, let's say, the DAX been able to break through 16,000 as it's been trying? I mean, it's been kind of sideways for a month, while Europe economically has been standing out.
Yeah, no, I mean, to me, Europe has done well, right, as an equity market. I think it's kept pretty well paced with the U.S., which traditionally has not been the case. And I think there's plenty more to go. In fact, I've seen some work recently that suggests the cyclical kind of segment of the European equity markets are very, very cheap. You think about the energy space, which I think is interesting. Europe is paying record prices for power generation right now today as we speak, and I think there's quite an interesting opportunity perhaps brewing in the power and energy sector in Europe, particularly if we get a winter that maybe is a little colder than people expect. There are forecasts suggesting that this winter is going to be quite cold. And with all the talk of climate change and global warming, et cetera, there's maybe a little bit of a mismatch and perhaps an opportunity there. But look, to me, the story is that Europe is just starting to disperse the monies for its joint recovery and next gen project, as you know well. That's key. That money is going to continue to be dispersed over the next several years. 22, 23, 24 is when the bulk of that money gets dispersed. So I've said it before, and I'll say it again. I think the medium-term outlook of Europe is probably better than the United States or Asia, and it's not reflected in the price of the assets, whether the currency, the euro at 118 or so to the dollar is probably a little cheap, but I don't really think the currency is going to be the way to play. I do think the bonds, if you look at the 10-year bonds being minus 35 basis points, that seems to be, to me, mispriced, and I would expect that to change over time. And that would very much help the banks, which, as you know, is one of our big exposures within Europe. We have a big separate position in the European banks that we like a lot. And I'd note that Europe is starting to talk about banking union. Again, there were some press reports about that over the last couple of days. And so I think you're going to have German elections at the end of the month. Let's see how they turn out. I think there's a recognition of the need for Germany to focus on the future, particularly as it relates to climate and also digitalization, where I think all would agree that Germany's not where it should be. So we expect to see some action there. And we continue to look at the climate summit in November in Glasgow to see what happens there. Europe is leading the way in terms of green energy, green bond issuance. There's a lot of opportunity around Europe on that space as well on the climate side. So to me, I think Europe looks good. But the other thing we should probably touch on is Japan. When you talk about IFA and you think about US, IFA, and then EM, Japan has been the story the last couple of weeks, and I think that's that's going to continue. We've been long Japan. We have it's one of the biggest positions in our multi-asset portfolio. It's a 6% position, so we've been very happy with the action in the last couple of weeks in Japan, and we think it's going to continue. Great earnings growth. Activist investors pushing companies to make changes, political change, which the market is certainly viewed favorably. The likelihood of a significant supplemental budget coming in the next couple of months once we get through the LDP leadership process. So there's a lot to like in Japan. And of course, most importantly, Japan is a cyclical market. And we are just talking about a reopening in Asia. Japan could be a big beneficiary of that. So Europe is fine. No problems with Europe. Going to continue to stay there and hold our positions. But the big action within IFA is in Japan.
Yeah, no, I remember all of that, and I mean, and of course, we jumped into politics because it's, the economy is really, and politics are related. But I was going to ask a question, when you started speaking about Europe, which is, and you make that important distinction, which is, how much of what's happening in Europe is cyclical, how much is structural? Because people may be, some people in the market, okay, they may appreciate the fact that, okay, I mean, there's, Europe is ahead of the U.S. because now because of the five or first in first out story. So and they were late in vaccinating, and then they speeded things up. But am I correct, to have the impression that the market does not appreciate how much of a structural change is happening? And you mentioned the banks and the recovery fund, maybe because the market has been used to disappointment.
Yeah, no, I think that's definitely the case in Europe, right? Nobody likes Europe. Nobody has liked Europe for years. No one's needed to like Europe for years, right? You have to remember that the backdrop is 10 years plus of U.S. outperformance, led by the big cap tech stocks. And that's, you've almost had a whole generation of investors, mature without ever having to pay any attention to Europe or Japan, for the most part. And so I think that's an important point that you raise. And it's, I believe, well worth people's effort to understand what's going on in Europe, and ranging from kind of reorganization of the indices to what's happening with the next generation growth plan and the clean energy, the green energy focus of Europe, which is significant and way ahead of every other region, way ahead of the US, way ahead of Asia. Clean energy is a big focus in Europe, and therefore, given what we've talked about earlier with climate, that means they're ahead of the curve. And so, yes, I think you're absolutely right. The structural change, and as we touched on, I think potentially going to move into the banking sector and the financing sector, which I believe would be very, very constructive for Europe as a whole, because right now you have, each country has a couple of banks, and they're big in each country, but they're not big across the continent, and they're not big globally. And increasingly, if you accept the idea of the tripolar world and accept the idea of regional deepening and regional integration, then we need to have some regional, integration of financing companies and banks in Europe. And that seems to be where people are pushing, having argued that we've been through and cleaned up post 08, 09, been through the Greek debt crisis of 2012, 2013. We've been through COVID. We need to kind of start to size up and get bigger in the financial space in Europe. And so that's, to me, again, as someone who has a position, so I am speaking back in my book, I do think there's a real opportunity there for European financials. And so, yes, I'm, as I said, I think Europe, I've written it in the past, and I continue to feel strongly, Europe can be the region that wins the decade of the 2020s. And we could all turn around and look at 2030 and say, wow, who would have thought that Europe would have outperformed, maybe the US or globally? And so this year, year to date, Europe has been a great place to be. We've been significantly overweight. We have a big underweight in the US, a big overweight in non-US, particularly developed. So therefore, Europe and Japan. And as I said, we've been happy with how Europe has worked. Now it looks like Japan is going to start to work. They both work together, and we're going to continue to have good performance.
Yeah, it's still, I have some questions on Japan, but still with Europe. Should people be concerned, to some extent, or to any extent? I mean, with the German elections, and now it looks like Olaf Scholz with the SDP, is likely to be the next chancellor. But and how do you? I mean, in assuming that the SDP takes over, how would that change, policy and the investment landscape?
I don't think it makes for a huge change, right? Because Germany, again, is going to be governed by a coalition. Scholz may be the chancellor. As you point out, he certainly is the person, the politician that people would prefer to see as chancellor, at least if you go by current polling. But it's a party game in Europe, not an individual game in Germany. And so therefore, we have to see what the coalition looks like. It does look like the SPD is surging as we approach. I think the election's on the 26th of this month, so a couple weeks away. But I don't expect to see a dramatic shift in policy. As I said before, I think there's a clear recognition that Germany needs to continue to spend on climate, and they need to spend on digitalization. Germany has kind of fallen behind on a couple of key areas, and this is one of the downsides of having someone like an Angela Merkel in power for 15 years. I mean, she's done a pretty impressive job, but there are areas where Germany is not where it needs to be if it wants to continue to help lead Europe going forward. The other point I would just make in terms of politics, and then we should probably move on, is the impact of what's gone on in Afghanistan and the renewal of discussions on both the economic and defense front of strategic autonomy for Europe. And this is something that the French talk about a fair bit, and I think we'll hear more of. And again, from my perspective, with the tripolar world thesis, Europe's strategic autonomy makes a lot of sense. And I think we're going to see more of that. And you look at the company side, you look at just the headlines in the last day or two. Toyota going to be putting electric battery production plants all around the world. Intel going to be producing semi-fab plants around the world. Production is being kind of regionalized. We're pulling back from globalization towards regionalization. And I think all this makes sense. And so I expect to see, as we go forward in Europe, a growing recognition of the need to think for themselves as a region, both in terms of defense as well as the economy. And I think it really manifests itself when you see the U.S. and Europe kind of talk about China, where the U.S. wants to see a united front between the U.S. and Europe. And Europe is saying, well, China's our biggest trading partner, and we have to approach them in a certain fashion. So, you know, the world is changing, and that's what makes it exciting. But to me, I don't think we're going to see, you know, in October, November of this year, a dramatic shift in the policy framework for Germany as a result of the election.
Yeah, no, it's very interesting because, you know, what you said about Angela Merkel, because I think, you know, her qualities, I mean, and of course, you know, she's leaving with, you know, 80% approval ratings. But when, you know, I think her qualities were most appreciated when stability was needed. So stability, consensus building, and that sort of thing. But now, I mean, I think, you know, of course, Germany needs innovation and needs to move faster and needs a more activist government in some respects. So, and I will just add, you know, if you allow me, to the point that, you know, there should be no concern on the if there is a changeover to the SDP, because, you know, Olaf Scholz is the current finance minister.
Yes, exactly.
And people don't appreciate that actually the reforms that have allowed, you know, Germany to do so well in the 16 years of Merkel's tenure were approved by the Social Democratic government of Schröder. So I mean, I think it should be. I mean, I don't think it should be any stress because of that. And now moving to Japan, it looks like, you know, we're going to have a new leadership, right? And more spending and so forth. So and it seems to be, you know, the first COVID. I mean, the serious COVID casualty in the democratic world, correct?
In terms of Prime Minister Suga stepping down, yes, yeah, I think it's fair to say that his performance there was not up to par, and therefore he's leaving. And I think that clears the way for a new leadership. But Japan has caught up quickly and does plan to have 75% or so of its population vaccinated, fully vaccinated, by the end of November, if I recall correctly. And so there too, things are moving fast, and the supplemental budget is being discussed already. So there's going to be some new government with the new some new money. Japan too needs to move forward on digitalization. Suga did talk about reaching peak carbon and moving aggressively on climate. So I imagine that will continue. And Japan has a history of as a stock market of doing well in the run up to new leadership. So traditionally, it outperforms ACWI during this period. And as we've seen, it certainly has had a pretty strong move here over the last week or so. But all that does is, I think, draw attention to the fact that you have companies generating very aggressive earnings, very cheap companies on a global basis, cyclical companies exposed to Asia. If we're correct on the idea that Asia is going to have a reopening going forward, Japan should be a very appealing play on that. And so to me, the upside there remains considerable. Japan has done nothing virtually up until the last 2 weeks, was basically flat for the year, versus ACWI up 15% or so. So it's got a lot of room to catch up. And I think, it's definitely worth people paying some attention to. As I said, it's one of the biggest positions, one of the biggest single positions in our global multi-asset portfolio is Japan equity.
Mm-hmm. No, fantastic. And we didn't really talk about the last jobs report in the U.S.
Mm-hmm.
And of course, I think during the Jackson Hole conference, I think Powell, he in using his own words, he doesn't want to rock the boat. So how do you see the reaction to payroll, and it also, is it just data dependency? What's your take from there?
Well, as we saw, right, the bulk of the kind of miss was in the leisure and hospitality sector, right? And that speaks to COVID and the Delta variant, and the fact that sadly and unfortunately, large segments of the U.S. population didn't feel the need to get vaccinated. Very hard for me to understand, being a New Yorker, but nonetheless, that is the case. And so that's where the miss was. I think it was offset by the fact that the prior month's numbers were revised up, that the earnings were pretty good. And so markets, I think, took it reasonably well. But now you're seeing people taking that information and lowering their Q3 numbers. Virtually everyone is maintaining or increasing their Q4 and 2022 numbers, which I think is very important, because, again, we're investors. Markets are forward-looking. We don't really care. We shouldn't care what Q3 GDP is going to be. We should be much more focused on Q4 in the first half of 2022. And that's certainly where I am focused. So I think the point about policy and governments and politics is, I want to make 2 points that I think are really important. The first is that big government is here, right? That we are going to get used to a more activist government. COVID, climate, cyber, etc., cannot be dealt with by individual companies. So big government is, I believe, here to stay. We've had 40 years since the 80s of small government.
I would just take notes. So
I'm sorry. I was just saying, I'll just go ahead and continue. So as I was saying, we've had 40 years of, small government is good. And ever since the Reagan Thatcher years, I think we've made a significant sea change. COVID initiated it, climate requires it, and cyber will further require it. If we're going to digitalize everything, then we need cybersecurity, and that needs to be both a private and public sector endeavor. The other thing I would mention, I want to focus on, is the idea that big government can help elevate the developed economies onto a higher growth path, an above trend growth path. And this, I think, is really important because, again, kind of like the Asian reopening idea, virtually nobody is talking about sustained above trend growth. And here's how we can get there. Pro-cyclical fiscal policies coupled with monetary policy that does not get out of whack. So taper is fine, but not jacking up interest rates. And I think that's what we're going to get. Coupled with a CapEx boom. We've had complete underinvestment in CapEx, both public and private in the United States for decades. And again, it's being manifest and seen every day with climate. Climate is the pressure. It's the force that is revealing the underinvestment in infrastructure in the United States. So we are going to have a CapEx boom. Climate requires it. And as we talked about with Toyota and Intel, companies are building out production in each region. This is going to be tremendously important over the next couple of years. And the third phase is productivity, surging productivity as a result of the adoption and accelerated adoption of technology, driven again by COVID speed. So pro-cyclical policies, big government policies, CapEx boom, and surging productivity could lead to not just 2021 and 2022 above trend growth years, but 2021 to 2025 perhaps above trend growth in the developed economies, which no one is talking about and virtually no one thinks has any real chance of a possibility. I think there's a reasonably good chance that that's what we're going to get in the US and Europe and even perhaps Japan relative to its own trend growth rate of the last couple of decades. So that is that's the upside of big government. So from my point of view, we should be excited about this opportunity because we've been stuck since 08, 09 in a subpar growth path in the developed economies, which has led to a lot of political pressure and populism and unhappy people, unhappy voters, which has led to some political uncertainty, which we've experienced all throughout the world. And so to me, above trend growth fostered by those big three, pro-cyclical spending, CapEx boom, and productivity surge, those are the things that we can look at. And by the way, if we get those, that suggests that margins and company margins will remain high, that earnings will remain robust, and we can have a handoff from liquidity-driven markets, which is what we've had, to earnings-driven markets, which is where I think we're going. And that should allow us to have a taper. That should allow rates to gradually work their way back up, which again, we should be happy to have rates work their way back up because it allows the central banks to have a little room to cut again if need be. When you're on the zero bound, it's a very dangerous place to be. So a little inflation, above trend growth, good corporate margins, good earnings. It's an environment that may be Pollyannish. I mean, I know I'm starting to listen to myself. I'm like, wow, that's too good to be true. And it may well be too good to be true. But I think we've got a better shot. My point would be, as an investor, we've got a better shot at that environment in the next couple of years than we have had in decades. And that's something to think about.
No, exactly. So there are two big, stories that are not in the market and are totally unappreciated, which we've heard in the last, 54 minutes, which is, of course, there's more than that, but there's two big ones. One, which, nobody's talking about, the reopening in Asia. And the stringency of lockdowns up to last week was as bad as the spring of 2020. And of course, you have touched a little bit on this before, but the capex boom and and the technology advancements that have been used, technology adaptation in the last year may lead to above par growth. And I don't think the market is appreciating this. And people talk about the lazy talk, as you say, which is bubble, and money printing and that sort of story. But as you say, it's lazy talk.
Yeah, and it really is, and it's a great point to maybe finish on, Roberto, because it reminds me that one of the things that we should really also touch on is how critical it is to understand that notwithstanding the daily new highs in the S&P, a big chunk of the US equity market and a big chunk of other markets globally have been in a stealth correction, right? And so we talk about small caps, and I write about this in the monthly. The average US small cap stock is off 20% plus from its 52-week high. If you look at energy, XLE is off 15% from its 52-week high of a couple of months ago. AMLP, which I love, one of my favorite investments in the energy space, the midstream energy pipeline company, 7% dividend yield. I write about this extensively in the monthly. 7% dividend yield, distribution coverage of 2 times, cheapest valuation in 15 years. Absolute, like, really big opportunity. I don't understand why it hasn't done better. It's done well. It's up 30% or so for the year to date, but still cheap. It said its cheapest valuation in 15 years because earnings are surging. So, I mean, I think it's important to note that there's a large chunk of the global equity markets that have not been hitting new all-time highs on a daily basis, and yet are starting to move, starting to pick up. And that's where we want to be. And so as we touched on, you know, Morgan Stanley put out some great work recently talking about how the hedge fund community in the United States up only 8% year to date versus the S&P up 20. We know that means that in the next month or two, there could be a push to performance. And more importantly, and interestingly, the hedge fund community is more crowded in the secular FANG type names than they've been at any point in the past year, are more underweight value and more short small caps than they've been at any point in the last couple of years. There's a real mismatch here within the equity market. So my points would be big chunks of the equity market, particularly cyclical value small caps, have been in a stealth correction, already happened. They're now coming out of it. That the hedge fund community is trailing, underperforming, and quite likely mispositioned versus where the opportunity set lies. And if we get that reopening that we talked about earlier in Asia, if we get some sense that we're going to have above trend growth, the cyclical value small cap non-US markets are going to do really well. And that's where we have been positioned, and that's where we continue to be positioned. We remain, you know, significantly overweight equities, significantly underweight fixed income, overweight commodities, overweight thematics, overweight cyclical and value and small caps, and think there's a real opportunity brewing in Asia.
No, excellent. And I mean, I was going to ask about emerging markets, but you know, Asia. I mean, most of Asia is emerging. I mean, of course, you can argue that Korea or Taiwan shouldn't be, but it is emerging, and it also seems that the technology, the regulatory crackdown on Chinese tech has stabilized, at least for now. So yeah, you know, we fully agree. You know, it's a great call. So you know, we have covered a lot, and yeah, you know, look forward to the next one, which is going to be in 10 days, you know, not 14 days. So yes. It's a week next Monday. So yes. I mean, it's great to have you again, you know, and we'll stay in touch. Thanks again, and you know, enjoy the rest of your week.
Thank you, Roberto, and thanks to the OHM research clients. Always great to be with you, and please get a look at the monthly. And if you have any questions regarding the model portfolios, feel free to reach out. More than happy to discuss.
Bye-bye. Thank you.
Bye-bye.